Hello, good morning, and welcome to today's Financially Speaking Monday morning money briefing. I'm just going to share my screen so that we've got the presentation up and ready for the breakdown of all of last week's major headlines. I'll also give it a few more moments to let anybody else that wants to join us this morning hop in so that they can, of course, do so. I know that we normally get kicked off relatively bright and early. So yeah, I'll give it, I know it's also mid-December, it's that busy time, isn't it? So I'll give it a few moments to let anybody else join us. Morning, Lisa, how are you?
Good morning. I'm doing well, thank you. How are you doing?
Yeah, very good, thanks. Very good. Feeling Christmassy. I was just
Yes.
mentioning as well, it's obviously a busy time, but this is actually our last Monday morning money briefing of the year, which is how 2025 has flown. We will be back with you in 2026 to start bringing you these again, so don't panic. Hopefully you've enjoyed it as a regular fix to your Mondays and to your weeks since we kicked off, but we will be back. And as always, the recording distributed to you after this as well. So don't panic. Again, you'll be able to see that. I think Lisa's just shared the link now too, that allows you to ask any questions that you may have whilst we're going through here on today's live session. It's just in a simple Slido link, so you should be able to see that in the chat there now. And with that, you can, as I say, ask anything that you want. No such thing as a silly question in my book. So without further ado, I'll kick off with what we're here for this morning. So if this is your first Financially Speaking, or if you've been to a few, you'll know the agenda now, which is that we go into one thing that we've all done to get that little bit closer to financial freedom here at Financial Freedom Coaching. Before going into what's happened in the UK, over the pond in the US, taking a look at a read of the week, Europe and the rest of the world as well. So we'll open up there with one thing that the three of us as founders have done to get us a little bit closer to financial freedom. Lisa, do you want to kick off?
Yes. So I have to say that mine is actually one that I haven't done yet, but I plan to do in the next couple of weeks. So it's obviously the end of the year. So now I'm planning to reflect on what I've done over the last year financially. So really look at where I wanted to go and where I actually went in fact. And also if I stuck to my budget. So all these like little things, how much I wanted to invest and whether that's actually worked in that way. So the next couple of weeks, I'm planning to do that analysis to really understand where we've sort of got to within the year. And I think this is kind of a really, really nice point to do that, because then in January, you can actually get started with your new plans for the year and understanding how much you want to allocate to each section and so on.
Yeah, lovely. A full annual roundup, a full looking at the rest of the year. I think it's a good time to do it, like you say, and it means you can go into January relatively strong. And the thing that I've done this week is also very similar. It's, as we say, coming up towards the end of the year. I've taken a look in on some investments, just had a little tweak of a few investment funds. I've become ever more aware of kind of how exposed a lot of us are to the US. So I've just had a look at where some of my funds are invested and made sure that I've still got a good level of geographical diversification within my portfolio as well. There's no such thing as a perfect balance or a perfect way to change if you're thinking, oh, maybe I should check in my investments and make a change, but rather just assessing what's in there, how it's performed, understanding what's going on is really key to long-term success within your investments as well. In fact, the less changes that you make in many ways, the better. I'll move us on to now last week's major markets, where we saw the FTSE 100, which is a measure of the 100 biggest companies in the UK, rise slightly by 0.32%. The S&P 500, which is the US stock market index of the 500 biggest companies in the US, rose just a little bit by 0.13%. The NASDAQ, which is the tech index, so lots of tech companies list on the NASDAQ, actually fell by 0.75%. Whilst the Eurostoxx 50 had the best week of them all, this is the measure of the 50 biggest companies across the Eurozone, and it rose by 1.06%. So if this is your first monthly briefing, then you will not necessarily be familiar with what these figures actually mean. What we'd say for last week is that it was a relatively flat week. with the exception of the Euro Stoxx 50. This is relatively small numbers, and that little bit of red there from the Nasdaq as a result isn't too dramatic. You start to get a feel for the kind of patterns that we do see week on week and how much we expect indexes to rise or fall. And as I say, this would kind of fall into a relatively flat, albeit positive week, because we haven't seen much change there at all. So you can really channel this into looking at your own investments. And when I talked there, and Lisa mentioned it as well, about doing your kind of annual check-ins, monthly check-ins, what you can start to see is a bit of a pattern, and you can understand what is going well and what's not going well, because without any reference point to that, it can be quite difficult as well. So what's happened then in the UK? Well, data was released around the UK economic growth figures, which is known as GDP, and it fell by 0.1%. That is, the growth of the UK was unfortunately not going in the direction that many would have hoped. And this is all due to a lot of budget uncertainty, consumer confidence, and also multiple disruptions. So stalled services across the UK within various different deliverables, but also therefore within production, all have raised recession risk and also caused this little bit of shrinkage within the economy. Now, most central banks, politicians, economics, and also, of course, consumers want some level of economic growth. So a shrink is never normally a good sign. There's always explanations for it, and it doesn't mean it's going to stay this way. It could well mean that when we move back into 2026, there's a bit of a boost again, a bit more spending, productivity's back in line, and there's no need to really panic. 0.1% as a shrink is still relatively small, but it's just not quite the news that anybody wanted to round 2025 off, not least of which because we're all still looking very closely at interest rates, where they're at, and whether they're likely to be cut again. Now, interest rates are closely tied to inflation, as many of us will know. What many central banks did was that they actually used interest rates to control inflation as it spiraled out of control 2-3 years ago. So interest rates have two main effects, just as a recap, which is that firstly, they make borrowing more expensive. So if you're paying, for example, a mortgage, then your interest rate goes up, then it becomes more expensive. But equally, if you've got cash in the bank that pays a level of interest, then it's much more appealing because you're going to get more for the cash in the bank by the interest rate rising. So what it basically means is that people spend less. And when controlling inflation, this is really important because less money goes into the system and hopefully dampens the effects of inflation, which is prices rising. Now, what we see with economic growth is that ties in as well. It's a bigger piece of the puzzle. Because normally what we see when inflation is rising, that actually in economic growth is not. It's normally stagnating because things are getting more expensive and people are spending less. It's exactly the same when interest rates come up because people are spending less. There's less incentive to do so. And so growth normally becomes a bit of a victim of higher interest rates. Now, as interest rates have started to come down, a lot of that is tied with stimulating the economy because we want people to start spending again. And as a result, we need some level of economic growth. Now, what we'll be all looking at is, are interest rates going to get cut again before the end of the year, particularly in light of this news that we've seen some growth shrinkage? Because maybe what we all need is a bit of a push, a bit of a boost to spend a bit more to get that growth moving again into 2026. Of course, none of us know. We'll be waiting that last Bank of England announcement, which I believe is this week, just to see if that cut is likely to happen. It's kind of 50-50 from everything I've read as to whether it is likely or not, but it may well be that this news ties into it. So what does all this mean then for you and your investments? Well, firstly, if you're sat here in the UK, it means that it's been a slightly tougher quarter than many expected from an economic perspective. And this could tie into interest rates. So if you're looking at mortgages or cash in the bank, you'll know what that potential could mean. However, what this means from a wider perspective, from an investing perspective, is not really all that much. It's kind of good news. It's almost one step removed. It's rare that stock markets respond superbly negatively to announcements like this around the economy. Sometimes they do if they're particularly dramatic, but it's a good one to note because often these are the main headlines that dominate the newspapers for the week. And it can be quick to see or quick to think that actually your investments are going to reflect that, but they don't always do so. As we saw, the FTSE was up slightly this week, and this news hasn't necessarily taken much of a hit to the overall market. So over the pond then in the US, where we saw the US trade deficit narrow to a 4-year low. This is a lot owing to their temporary gold exports that are currently happening, but also lifts their next GDP hopes. So their GDP news is due to be released this week, unlike the UK's, which was of course released last week. So it's hoped that these exports are really going to boost overall economic growth for the US, which is much needed. It's also hoped that it won't change their growth trends too much. So what does all this mean? It was a relatively quiet week on the markets last week, and what we saw was that this news was kind of what dominated the overall view. Again, it ties in with those interest rates. The Federal Reserve, which is the central bank in the US, did indeed decide to cut rates last week. So they brought them down, hopefully further stimulating their economic growth. This had been much awaited and wasn't necessarily a huge surprise, so it was digested relatively quickly by the markets, but it's certainly moving interest rates in the US and therefore across the globe, because as we say, the US sneezes and the world catches a cold, and they decided to drop it, so we'll likely see ever more drops coming. It's moved it now, their interest rates, I believe for anybody that's interested, are sat between 3.5 and 3.75, because in the US they have a hovering one. So what does all this mean then for you and your investments? Well, what it really shows is that growth is stagnating and it's becoming a part of the narrative around interest rates more than what we're seeing of inflation. It's becoming a bigger priority for many politicians and many central banks. Stagnating growth isn't necessarily great news for our investments, but it could mean a period of, at the very least, less volatility. Normally, what we tie that in with is a little bit less excitement. It sounds kind of silly and counterproductive, but if we do see a slightly recessionary period, what we'd probably expect is that the growth within our investments would slow, if not shrink a little bit, depending on how dramatic that recessionary period was. But it certainly could point towards certain industries coming through stronger than others. What we normally see in recessionary periods is that the likes of consumer staples, so the food we eat, as well as utilities and healthcare often come out strong. The reasons being is that they're often areas that we have to spend on, even in tougher times. Now, that's not to say that you should go and invest in just those exclusive areas. We very much advocate for a longer term, broader strategy than chopping and changing with such quick off the bat news. But what it could mean is that you start to see shifts within your investments and you want to maintain as well some level of sector diversification in your overall portfolio. On to then the read of the week, where The Guardian was examining whether net zero really will cost UK households the quoted amount of £500 a year. Unfortunately, definitely not fortunately, net zero and other climate goals have seemingly fallen down the list of priorities as things like inflation, interest rates, and economic growth have all taken front and centre in recent years, not least of which to mention the various different geopolitical tensions taking place across the globe, which have really dominated and overtaken what has gone on with climate change agendas. And I think it's fair to say that Britain is absolutely no exception to this issue. What this has meant is that with the temporary pause or the temporary slowing on various different projects, people are once again highlighted how much it's going to cost to make sure that we get as a planet to net zero, and also to try and get more and more infrastructure in place that really assists this. So Britain's energy system operator has said that reaching net zero requires rapidly rising investment. It's going to be up to the value, they say, of around £460 billion by 2029. Whilst this is faster action, these delays could raise, of course, future costs. If you're interested in it as an area, it's certainly one to read a lot about. And it's certainly one that could provoke lots of interesting results within longer term investments and longer term economies as well. It is still a growing area for investments. It's not going away. It's not a problem that we can just think away. I'm sure many politicians out there would like that to be the case, but it's not. But the costs long term of not implementing this infrastructure could be huge. It's certainly one to keep an eye on, but try not to get too bogged down in when it comes to your investments and making decisions. Because, and I won't say this lightly, it's an absolute minefield, an ongoing realm of contradictions and compromises within that environmental space. So let's take a look then at Europe, where first up we saw Russia suing Euroclear over frozen reserves. This really escalated legal tensions as the EU is seeking to use frozen assets to help finance the war efforts in Ukraine. This dispute really raises some geopolitical risks and threatens the potential for other asset seizures. And more than anything, it just causes more uncertainty. It unsettles to a certain level European financing of the war effort, and it might push investors, and that is global investors when we're saying that, towards safer, in inverted commas, assets amid these ongoing Russia-Ukraine tensions. This has been bubbling on, as many of us know, for years now. And I'd seen some predictions as to whether people think that Trump's peace deal that he's trying to broker will be accepted, whether it will come into play in 2026. And the outlook is not superbly positive. It certainly doesn't seem to be the case that Ukraine are willing to accept the peace deal that has been laid out. And what that means is that they're still needing ongoing funding for the war. And a lot of this is now coming from Europe, who are well known for helping, but don't necessarily have the deepest pockets when it comes to the military spending when we're comparing with the likes of the US. If this then therefore continues, what it could mean is that pressure is put on European defence spending and pushing up government spending overall in an area that doesn't necessarily have a clear endpoint to it. So what does this mean then for you and your investments? Well, it means that those who have defence, for example, in their portfolios are likely looking at still a prolonged period where defence is needed, and therefore defence stocks are likely to look positive. However, what it means from a more economic perspective is that this ongoing spending could mean that Europe over the longer term starts to suffer a little bit with attractiveness. It could well be that investors pivot back towards higher growth areas. Europe isn't renowned for being a high growth area. It's known for being steady away and generating a solid dividend. But if this starts to dry up, if their dividends can't be paid as much anymore because actually the coffers are looking a bit lower, then it could really shift how global investors view Europe as a region. It's not one to panic about for right now, but one to take a step back and have a look at as we assess into the new year and beyond as well. The sort of shifting scene of what various different geopolitical tensions can cause, provoke, and result in for our own portfolios. On to next, where we've seen the EU also announcing to try and protect their small electric vehicle category and possibly banning engines to shield domestic car makers from the likes of Chinese competition. This is particularly in the face of relatively weak demand for domestically made automobiles and cars and different vehicles. So this policy shift that, if it gets introduced, could lift various different European-based automobile stocks. It could also boost supply chains, but as with any regulatory change, it adds uncertainty and risks slowing innovation within the region if the likes of the Chinese vehicles that are coming in are much more innovative, newer, and frankly cheaper as well. So what does this mean for you and your investments? Well, it's a tale that we've heard a lot of over the last year. Tariffs, protectionism, and making sure that the global order that we're seeing shifting doesn't disrupt too much the home economies and production lines. So for your investments, when we're looking at this, it's just a little bit of a shift. It's not necessarily anything dramatic. And of course, this policy hasn't even been introduced. If you're invested directly into various different electric vehicles, they're quite a volatile sector. And it's certainly one where we're still seeing that run to the top and the various different companies pushing for the winning number, if you like. But what it could mean is that we do start to see within certain sectors like cars some shifts across the globe, some movements as well. And we've already started to see it, let's be honest, but it could well change into the future. Certainly one to watch. And to the rest of the world, then, where it seems like the Eurozone are the only ones at it. Mexico imposed steep tariffs on Chinese cars last week. This is reportedly to protect their own industry, but also crucially to align with pressure put on them by the US. They also want to secure various different access points on an upcoming review with the US, so they're doing what they can to remain in their good books. So, what does this mean for you and your investments? Well, again, tying in with that overall view of electric vehicles and other industries across the globe, these tariffs are causing ever more shifts within that kind of global order. It's not necessarily a bad thing, and it's not necessarily something that you'll see pan out immediately within your investments, but it is something that we might see start to shift over time. On to then China, where China have pledged to revive fixed asset investment. That's normally investments into the likes of government bonds and other forms of bonds as well. This is to help support property infrastructure. The Chinese property market has famously had quite a tough few years, but it's also to help support technology amid slowing growth and relatively weak demand in China. The property market first hit a bit of a road bump in China in 2019, so pre-pandemic. Then, of course, we saw the COVID-19 pandemic hit, and this caused absolute pandemonium within their property market and overall domestic spending and growth as well. This tail's kind of dragged on for the last 5 or 6 years, but China are really trying to find solutions to it, because the more people that there are buying property, the more spending, the more infrastructure they've got, the better it is for their overall long-term economic growth perspectives. And of course, this ties in with their stock market as well. If their economy is booming, then generally so will their stock market be too. So what does this mean then for you and your investments? Well, it's unlikely that you're going to be buying into fixed asset Chinese investments. It's probably one stage removed from the vast majority of us as retail investors. But what it could mean is that within, for example, emerging market portfolios or emerging market funds, if you've got them, we are still seeing China fighting to get their position of really strong growth back. And over the coming years, with these policies successfully implemented, it could well be that we continue to see them grow in a strong way. And last but not least, onto Sudan, where we see ongoing conflict within the region, but notably last week with an oil field that was seized. This temporarily halted output and also disrupted South Sudan's exports, deepening their civil war and regional instability risks. So what does this mean then for you and your investments? It's another area of political tensions and ongoing conflict, which of course from a humanitarian end is desperately sad. But what it means from an economic and investment perspective is also pretty tough. It means that as a country is struggling, it means that there is inevitably more spending in that defence area, and it means that there will be likely others looking on to see if there's any intervention needed, especially when the likes of oil fields are involved. This could cause a temporary disruption to oil prices, but it's unlikely. There are other major suppliers across the globe. Sudan is not the center and the kind of be all and end all, if you like, of oil for the globe. As I say, the bigger takeaway from this is it's just more conflict, which generally causes more volatility and a bit more of a boost to those defense stocks. So I'll move into now the Q&A. Do ask away if you've got any questions into that Slido link. And of course, if there's anything that comes up in the week, do just drop us an email at hello@myfinancialfreedomcoach.co.uk. We'd be more than happy to answer.
Amazing. Thank you so much, Zoe. As always, super informative here for our last session of the year. So I can only see one question in the Q&A so far, but it might well be that more will pop up as we talk. So the first one was about the UK gross, and it says, is the UK gross in the 3 months to October fell by 0.1% as expected or worse than expected?
Oh yeah, good question. So it was actually a bit of a surprise. I think most positively hoped it had grown a little bit. And that surprise is rarely well met because markets don't respond normally well to surprises. They like certainty. But we saw in the FTSE last week, it still climbed a little bit. So whilst I say it was a bit of a surprise, it still wasn't a total shock, if you like. It was kind of a, oh, we didn't think it was going to quite be that. We were hoping for more, but not necessarily a gas.
Yeah. Okay, fantastic. Thank you, Zoe. And then would you mind just repeating for everybody when market news is on and when it isn't on, so everybody kind of like knows?
Yeah, of course. So as I say, this will be our last one of the year now. Next week's the 22nd, the 29th will be off, but we should be back on the 5th of January to be bringing you again the updates from what has happened over the festive period. We do normally see what is known as a bit of a Santa rally in markets, so December's normally quite positive. Last year was an exception to that rule, so let's all cross our fingers and hope for what's to come.
Perfect. Thank you. And then last question. Could you just talk people a bit through some of the things that are going to be going on in January in terms of Financial Freedom Code?
Yeah, absolutely. So we're coming back to January with an absolute bang. We've got some fantastic webinars lined up for the new year. We've also got group coaching sessions that we'll be launching. You'll be able to sign up to them on the website, and we'll be hosting a maximum of 12 people in them. So the spaces will be going really, really quick. We've already got a few that have gone. The idea of group coaching is that you have some level of community and accountability. It's totally confidential what is shared within the group, and you can choose how much you do share. But the idea is that unlike one-to-one coaching where you're very much just working alone, you have much more accountability and potential buddies to keep you going into the future as well. Often we find that these group coaching periods can be really, really successful because people do find others on a similar level, and they find that going through that journey can be really quite powerful.
Amazing. That sounds fantastic. Awesome. Well, thank you so much, Zoe, and I wish everyone a happy end to this year and a lovely start to the next one.
Yeah, absolutely. Me too. Have a lovely Christmas festive period and New Year. Bye for now.
Bye.